Welcome back. I am Kunal from EPK Capital. If you are watching this, you've likely already made it. You have capital. You have a portfolio. You probably own real estate, some gold, a solid equity portfolio. And maybe, just maybe, you dipped your toes into Bitcoin because your friends wouldn't stop talking about it at dinner. But here is the uncomfortable truth. The way you created your wealth is rarely the way you keep it. Most investors I meet, even those with $5 or $10 million in liquidity, are still making the same three mistakes. 1. They chase hype. 2. They think diversification means buying 5 different tech stocks instead of one. And 3. They ignore the invisible asset classes. Today, we are going beyond stocks, beyond bonds, and definitely beyond Bitcoin. I am going to walk you through 5 alternative asset classes that the institutional elites, the family offices, the endowments have been quietly using for decades. These are assets that don't care if the stock market crashes tomorrow. Let's dive in. Asset number 1 is something you might find surprising. It's called litigation finance. In simple terms, you are funding a lawsuit. Now, before you worry about the ethics, hear me out. Commercial litigation, companies suing other companies for breach of contract or patent infringement, is incredibly expensive. Even large corporations prefer not to tie up millions of dollars in legal fees for years. This is where you come in. Through specialized funds, you finance the legal costs. In exchange, if the case is won, you get a share of the settlement. If the case is lost, you usually get nothing, which is why these funds are highly diversified across hundreds of cases. Why do UHNI investors love this? Because the outcome of a court case has zero correlation to the stock market. The judge doesn't care if the Nifty 50 is down or if the Fed raised interest rates. The returns? Historically, this asset class has targeted internal rates of return of 15% to 20% globally. It's a pure, outcome-based investment. For my Indian clients, we access this through specific AIF structures or global feeder funds via the LRS route. It's complex, yes, but it's a powerful hedge against economic recession. Let's move to something a bit more melodic. Asset number 2, music royalties. Every time you stream a song on Spotify, hear it in a Netflix show, or listen to it on the radio, someone gets paid. Why shouldn't that be you? Investing in music catalogs used to be reserved for record labels. Today, we treat songs as assets with predictable cash flows. Think of it like buying an apartment and collecting rent. Except your tenant is a classic rock song or a Bollywood hit, and they never miss a payment. The beauty here is yield. In a world where bond yields are volatile, music royalties can offer annualized yields of 6% to 12%. And just like litigation finance, music is uncorrelated. Even in a recession, people don't stop listening to music. Now, let's talk about the engine of the new economy. Asset number 3, private credit and venture debt. Traditionally, if a startup or a mid-sized company needed money, they went to a bank. But banks are slow, conservative, and often say, no, you act as the bank. You lend money to high-growth, VC-backed companies. In return, you get a regular interest payment, usually significantly higher than a standard bond, plus, and this is the kicker, you often get a small equity upside known as warrants. In India, this space is exploding. With the AIF regulations, we are seeing well-managed funds delivering 12% to 14% pre-tax yields. The mistake investors make here? Trying to do it directly. Do not lend to your friend's startup personally. That is charity, not investing. You need a manager who understands underwriting risk. Asset number 4 is for those who appreciate the finer things. Rare whiskey casks. I'm not talking about buying bottles to put on your shelf. I'm talking about owning the cask itself, maturing in a bonded warehouse in Scotland. Here is the economics. Whiskey must age. A 12-year-old single malt is worth significantly less than an 18-year-old. As the liquid sits in the wood, it becomes scarcer and more valuable. It is a natural appreciation curve. It's tangible, it's scarce, and unlike gold, which just sits there, whiskey literally gets better the longer you ignore it. Finally, asset number 5. This is for the forward thinkers. Carbon credits and green assets. The world is moving toward net zero. It's not just a slogan, it's a regulatory mandate. Corporations, from airlines to tech giants, are legally required to offset their emissions. To do that, they need to buy carbon credits. Supply is limited. Demand is skyrocketing. By investing in accredited green projects, forestry, renewable energy infrastructure, or direct carbon trading funds, you are betting on the price of pollution going up. This is an asset class that didn't really exist for individuals 10 years ago. Now, it's a legitimate part of a UNI portfolio. It adds an ESG layer to your wealth. But more importantly, it positions you on the right side of history and regulation. Litigation, music, venture debt, whiskey, carbon. Why did I list these? Not because I want you to go out and buy all 5 tomorrow. I listed them to prove a point. Real wealth management is not about picking the next winning stock. It is about constructing a fortress. A fortress where, if the stock market drops 20%, your litigation fund still pays out. If inflation hits 8%, your whiskey cask appreciates to match it. The biggest mistake I see UHNI investors make is complacency. You have the capital, but you are using the same tools as someone with $10,000. You have access to the private markets, use them. At EPK Capital, we don't just sell products, we architect portfolios. If you are sitting on liquid capital and you feel your portfolio is too exposed to the public markets, let's have a conversation. Click the link in the description. I'm Kunal from EPK Capital. Let's build wealth for generations.